Hello, everyone. Thanks for joining us today. I'm Rebecca Beck. I work here at the North Carolina Center for Nonprofits and our programs team. I also have with me today Leslie, who's in the background, managing all of our tech. All lines have been muted upon entry, and we invite you all to go ahead and use the chat for any questions you have, to go ahead and add reactions in there as we're going through the presentation today. If you're here with us for our session with Chazin about nonprofit accounting basics for non-accountants, I'm one of those non-accountants, so I'm really looking forward to today's session. You are in the right place. We're delighted to have Jackie with us today. I'll read her bio pretty briefly, and then I'll probably turn it over to her to get rolling. So Jackie is a CPA with Chazin, and she's been a CPA for over 35 years, including 18 years dedicated to nonprofit organizations. So she knows the nonprofit speak, especially when it comes to finances and accounting. She started her career at KPMG auditing tech startups, and she advanced to audit leadership roles in Fortune 500 companies before transitioning to nonprofit financial management. So she's done it all. At Chazin, Jackie oversees technical reviews, training, and financial reviews, ensuring nonprofits meet the highest standards of fiscal responsibility. She's an accomplished educator, and she's spent 10 years as a top-rated instructor for the nation's largest CPA review provider, and has taught financial tools and strategies to small business owners and CPAs. So we are in for a treat. It's a delight to have you here, Jackie. We're going to go ahead and let you share your screen, and we're going to spotlight you as the speaker. And we'll get rolling. Thanks for being with us today, everybody.
Thank you so much, Rebecca. And did I successfully share that screen? Can everybody see it?
You did.
Terrific. Okay. So I'm going to get going here. I will warn you in advance that I will not be speaking in debits and credits, and hopefully I will be using non-accounting jargon language, hopefully, so that you can actually understand what I say. As a side note, Chazin is outsourced accounting, and I like to say we are like an a la carte menu. So if you have an accounting team and they just need like a little spotting, like a spotter at the gym, we can do that. If you don't have an accounting team, we can take over all your accounting functions as well. So that said, let's get going on nonprofit accounting for non-accountants. So first, we're going to understand why it's important to understand your financial statements, and just as importantly, what may be holding you back. Next, we're going to introduce you to the primary financial statements and how to pick out what's important. And of course, we're going to cover the common accounting challenges nonprofits face, which happens to be my rant right now in our current climate of challenging funding for nonprofits. And we're going to learn some best practices. So why should you care about finances? Now, I have this lovely slide that tells you all the reasons why you should care about finances, but here's the bottom line. If all of you are like me, once a year you go to your doctor and you have your annual physical. And if your doctor's like my doctor, they order some blood tests to be run, some standard blood tests. And if you spend 365 days eating a mostly healthful foods and moving your body a little bit, whether that's walking or going to the gym, for the most part, and there's outliers, you're not worried about your blood tests because all year long you're getting nutritional food and you're moving your body. So your blood test for your annual physical is just almost perfunctory. Your financial health, and you're going, what the heck does that have to do with financial statements? If you pay attention to your financial health on a weekly or monthly basis, and we're going to recommend monthly, of course, if you pay attention to your financial health on a monthly basis, and if you're audited at the end of the year, your audit becomes largely perfunctory. Also, the point in eating correctly 365 days a year and walking or going to the gym or whatever your activity of choice is, The point in all of that is to be a healthy person. Looking at your financials on a monthly basis, the point of that is to create a financially healthy organization. And why should you do that? Because your organization cannot be sustained for the long haul unless it's financially healthy. So a lot of times what we find is what's holding the non-accountant back is that it seems so difficult. And I think what adds to that is auditors and many accounting professionals love to use accounting jargon. And as I like to say, normal people, i.e. people who aren't accountants, don't always understand that accounting jargon. But often you don't want to slow the accountant down and say, hang on, I don't really understand what you're saying. That's very normal too, because you don't want an answer that's full of more accounting jargon. So as the nonprofit leader, you can kind of pull out of those weeds and look at it as cash in, cash out. Now, some of you who've dug into the accounting jargon a little bit more can argue with me that it is a little bit more than that, and that's true. The accountants can take it from there. But as the nonprofit leader, you need to be focused on how much cash is coming in and how much cash is going out. So again, oftentimes finances are uncomfortable for nonprofits, profit leaders for a couple of reasons that I mentioned. Either it seems overwhelming because there's so much jargon, or secondarily, oftentimes in nonprofits, the accounting department is so far behind that it just feels like they can never dig out. And so you don't necessarily demand financial statements every month. A way to overcome that uncomfortable feeling is just to shift your perspective about it, because numbers just tell a story. That's all they do. They tell the story about what your organization has done in the last year, how successful your fundraising department or your membership departments have been, if you were monitoring your expenses and spending wisely, or if you weren't. If you created a new event, it will tell the story of how successful that event is. So they are nothing more than a storytelling machine. The problem is that I like to use the example, if I went to Japan, I don't speak Japanese. So if I'm going to go to Japan, I need a translator to help translate from English to Japanese. For a lot of nonprofit leaders who aren't accountants, you kind of have that same problem. Your numbers are equivalent to me asking you to speak Japanese. And what you need are some good accountants that can be your translators and translate the numbers into the story for you. So that said, let's dive in. You can see here that for-profits, and many of you are familiar with these for-profit words: balance sheet, income statement, also known as a P&L. By the way, somebody asked me once, what's P&L stand for? Profit and loss. I use the terminology P&L. Statements of cash flow and budget versus actual. You can see on the right side of this slide, nonprofits have different terminology. When I do these trainings for non-accountants, I always use the for-profit terminology, because most everybody on this call, if I say balance sheet, you know what I'm talking about. If I say statement of financial position, some of you may know and some of you don't know. So I'm going to stick to the for-profit language here because it's just language we're all more familiar with. All right, so when I put this slide up, people always look at me like I'm a crazy person, because you'll see that this slide says to understand LeBron James is to understand financial statements. Frankly, I should have changed this to Patrick Mahomes because it's football season. But here's the point where LeBron and financial statements dovetail. LeBron has season stats. And at the beginning of LeBron's season, his season stats are 0 because he hasn't played any games. And as soon as he starts playing games, the statisticians will accumulate things like how many points on the board he's had, how many assists, how many free throws he's made. and a lot of other stats. Those of you who love basketball, forgive me, I don't know much about it. But I think we can all agree that there are statisticians keeping track of LeBron's season stats. At the end of a season, LeBron's season stats zero out. They have to so that he can start next season at 0 and accumulate season stats again next season. But when at the end of a season, when his season stats zero out, they don't disappear. They aggregate in with his career stats. His season stats aggregate with his career stats, and he starts all over again with a new season. So why do I say this? LeBron's season stats is like your P&L. LeBron's career stats is like your balance sheet. At the end of your season, which is your fiscal year, your P&L will zero out, but it doesn't disappear. It aggregates in with your balance sheet and you start all over again next year. Now, like LeBron, I think everybody on this call would agree, if LeBron has a bad game, it doesn't mean he's going to have a bad season. It just means he had a bad game. The same is true with you and your organizations. If your organization has a bad month, keep in mind it doesn't necessarily mean you're going to have a bad season. And in some upcoming slides, we're going to talk about how you, like LeBron, can take steps to make sure your season's not bad. Oh, we're going to do it right now. So after every single game, LeBron reviews the footage of the game that he just played. And he reviews that footage for two things. He reviews it for what he did wrong so he can correct it. And he reviews it for what he did right so he can do more of that. Additionally, before every game, LeBron and his teammates have a plan for how they're going to play that game. And in all likelihood, they've got some plays lined out and they've studied their opposing team and they have a plan. When LeBron is reviewing that game footage of the previous game, he's also looking at how they actually played relative to their plan. So for you in the nonprofit world, this is called your budget versus actual report that you should get every single month. So your budget is your plan, and you do this before the start of your fiscal year. So if you have a January 1, you start your new fiscal year January 1, you should be working on your budget right now because you're going to have to prepare it. It's going to get edited. Your board has to approve it all before January 1. Then when January 1 starts, you're actually executing your business, and everything you do in your organization has a financial consequence. Everything. So at the end of January, you should close your month, or your accounting team should close your month. And part of closing that month means looking at how you budgeted to do that month and how you actually did that month. Because remember, oftentimes you have a perception of your actual performance, which may or may not be accurate, but your numbers will bring you back into an accurate, objective idea of how you did. When you get that budget to actual report, like LeBron, you're not only going to investigate your bad variances where maybe you overspent a little, but you also want to investigate your good variances. Maybe your fundraising team did better than expected, or your membership team did better than expected. That's awesome. Why? Why did they do better than expected? And that why is important because how can you keep doing more of it? So this is an example of a budget versus actual report. And I've highlighted some of the larger variances in the far right column. These are all made up numbers, just for the record. Obviously, in this example, it's a school because we have tuition billing as a revenue item. But the very first number I highlighted is where they actually did better than budget, and they exceeded budget by 268,000. So this is where they're looking to give their fundraising, enrollment people, membership, if you're a membership organization, a high five and ask them what they did that encouraged this positive variance so you can do more of it. Further down, the next benefit is $15,000. Again, this is, although it looks like a negative, in this particular case, this organization spent less than they budgeted on employee benefits. So this is important information to know too. Hopefully you budgeted with 8% increase in mind for your health insurance, and maybe your increase only came in at 3%. Hopefully it's some good news like that. And then down at the very bottom, the third variance I highlighted is 32,000. In this case, they spent more on student room and board than they budgeted. Now, on the surface, this looks bad. They overspent their student room and board budget. But if you take it in context to the very top variance I pointed out, they did better in their student revenue. And probably they did better because they enrolled more students. So in that situation, they have more students enrolled, which gave a positive revenue variance. Therefore, they're going to have a higher student room and board expense. And so in this particular situation, that 32,000 overspend is not a bad thing. So as the nonprofit leader, these are certainly the large variances that you want to look at. Now, given that most of you are probably executive directors or budget managers and definitely decision makers, you may want to drill down on some of these smaller variances, like here about 40% of the way through, the outside accounting services were overspent by $4,700. So that may be a variance that you want to look at and go, why did this happen? And maybe this financial statement is the February financials, and maybe that happened because your accountants had to do your 1099s for a year. But as the nonprofit leader, your job is to look at these variances, dig down into them, and when they are bad variances, have a plan, just like LeBron does, for course correcting the next month. And I think Glenessa, did I say that right? You have a
But
question.
yeah, that H is part of my last name, so it's Glenice.
Oh, okay.
It's
Sorry
so
about that.
weird. Do have a question, and I apologize if this. Are you just so I understand? Will you be asking for questions at the end? Is it okay to raise hand during the?
All throughout, Rebecca and I were talking because if you have a
Okay.
question about something, chances are other
Yeah.
people do too. So it's nice to address it along the way.
Well, I am absolutely your academic, excuse me, a non-budget person, finance person. So this is kind of newish to me, so forgive me if the questions are absolutely ridiculous, but
Okay.
I wanted to make sure I understood. At one point, I thought I understood actual to budget to variance until I saw the first line. So it's had me in my tracks on the first line. I wanted to make sure I understood when we spoke about, and this, I know it's an example, but the 4,000 for tuition billing, and we spoke about what the actual was, and then how much was budgeted, and then the variance. I, I thought the variance was the difference between the two.
It should be.
It is-
So
and
if it's not, I did the math wrong when I
No.
did this.
So in the variance would be, and you said in parentheses, if it's in parentheses, that's negative, or is that positive?
In the revenue side, if it's
Yeah,
in
when you have
parentheses,
parentheses.
that's a bummer because look down at application fees. This example, they brought in less revenue than they budgeted.
Okay,
So that $1,600 is a bummer in this case.
okay.
But that's in the revenue side of
So
things.
that's, okay, okay. Just wanna make
So
sure.
if you go, and you know what, each accountant's going to do your budget to actual. So a little different. So don't take the parentheses rule to heart
Yeah,
because
okay,
each one might do it different. In
do it
this
different,
example,
okay.
though, if you look
Or,
at gross wages, it's a
yeah,
negative variance, but they're actually under the budget. They spent
yeah,
less than they thought.
okay. Forgive me, everyone. Listen, I'll try
No,
not to
good.
do much of this throughout the process. I know this is like slide 2. It's like, oh my God. Okay, but I
That's
will.
okay. Good questions.
Maybe.
There are
Thank
no
you.
stupid questions.
No, there are none.
We
Mm-mm.
like to say that, don't we?
Okay,
Thank
so
you.
you open the door for me to go off on a tangent, which I warned Rebecca I would do. So those of you who are old enough to remember Enron, I would be in that group. At the time that Enron went bankrupt, it was the largest bankrupt in the history of this country at that time. It was devastating. Enron had an audit firm called Arthur Andersen. I call Arthur Andersen the Titanic because they had held the number one position in the world, not just this country, in the world. They were the number one audit firm for decades, if not hundreds of years. And everyone said Arthur Andersen would never go down. Now, many of you people who weren't around for Enron don't know who Arthur Andersen is because, like the Titanic, it sunk and Enron sunk them. But here's the point about no stupid questions. So, the Arthur Andersen partners, this is the highest level of professional on this Enron job. Arthur Andersen had put their best partners in the globe on the Enron job, best partners working for the number one audit firm. And when Jeff Skilling and Kenneth Lay were talking about all the shenanigans they were doing, of course, shenanigans is my word, they didn't phrase it as shenanigans. The Arthur Andersen partners didn't understand what they were doing and didn't understand why they were doing it. And these most brilliant accounting minds in the world were too embarrassed to sit at that conference table and ask the question and say, Jeff, I don't understand what you're doing and why you're doing it. Can you explain this to me? If those Arthur Andersen partners had asked those questions that they were too embarrassed to ask, Enron either may not have gone down or certainly wouldn't have taken as many people with it if the end result had still been the same. It would have been caught a lot earlier. So I love using that example. There's a million reasons why Enron failed and went down, but the foundational reason is you had a bunch of people sitting around a conference table who were too concerned that their questions were dumb, and their questions would not have been dumb. So little support for that. No question is a bad question.
Well, thank you. And I don't embarrass easily, so
Oh,
there's that.
good. Yeah, and Glennies, every single day I ask dozens and dozens of questions because that Enron story, and lots of times our staff will be like, "What?" They don't say this, but the look on their face, "What is wrong with you?" The answer's right there. And I always think, you know what? I would rather ask dozens and dozens of dumb questions than miss the important one and not ask that one. So. So now we're going to look at those season stats or your P&L as presented by the auditors, because the audit presentation is going to look a little bit different than the budget versus actual presentation. But I want to explain why, because the reason why the auditors present a little differently is important to your fundraising activities. So the first thing that you hopefully see here is there's a column without donor restrictions and with donor restrictions. So this is very, very important. If you are with a membership organization, you probably don't have a lot of this because you're making your money through membership dues and events. But if you don't have a membership organization and you're with an organization that feeds homeless people, and a lot of your revenue is coming in through contributions, this with and without donor restrictions is your risky and critical area in your financial statements. And here's why. if I'm just going to pick on Rebecca because I was talking to her before everybody jumped on, but if if Rebecca had an organization that fed homeless people and I gave Rebecca half $500,000 and I said, Rebecca, this money is to buy food for homeless people. Notice I was very specific. Buy food, Rebecca, for homeless people. Not condiments, not eating utensils, not napkins. Buy food to feed homeless people. That's a restriction. And as the donor, only I can restrict money. Rebecca and her board cannot decide to restrict money. They cannot do it. They can earmark it, which has a different name to it, but only I, as the donor, can restrict money. Rebecca has to spend that money on food. She has to. If she spends it on utilities and not food, she runs a whole lot of risks in doing that, including jeopardizing her funding, making me, the donor, angry, and possibly even running into some legal complications. So it's incredibly critical to track your revenue with and without donor restrictions. Now, once Rebecca spends the $500,000 I gave her on food, she can move that from the with donor restrictions to without donor restrictions, because at that point, she spent it on what I asked her to spend it on. And you can see here in this example, about halfway down, total net assets released from restriction. So getting back to picking on Rebecca a little bit, in this example of the money I gave her, she spent $94,000 of it on food. So she was able to move that money out of with donor restrictions and into without donor restrictions. The other important thing this auditor presentation does, if you go down to the lower half under expenses, you see program services. Now, in this case, there are two: animal care and education and outreach, but they're nested under program services, and then there's supporting services. Of course, I have a story for why this is important too. So it was the late 80s, early 90s, and I think it was the Red Cross. See, the Red Cross or United Way. They had a media disaster in that a large donor found out that a high proportion of what that donor was giving to them was being spent on the CEO's salary, the rent for the organization, utilities, etc. So most of us who are here in North Carolina can relate to this because last fall, we had a lot of our friends and neighbors devastated by Hurricane Helene. So if we were going to give money to the Red Cross, we want to give that money for the Red Cross to help our friends and neighbors who were devastated by Helene, to help feed them, clothe them, shelter them. Now, we know as reasonable donors that for every dollar we give the Red Cross, I don't know, 20 cents, whatever the number is, they'll have to use on rent and utilities and so forth to keep their staff working to help our friends and neighbors affected by Helene. We know that. But back in the 80s or 90s, it was a very high percentage of every dollar. And I don't remember, so I'm making it up, but it was like 80 cents on every dollar was going to overhead and not to help people like the victims of Hurricane Helene. The media got a hold of this and they went crazy. Now, fast forward, the organization, whichever, Red Cross, United Way, whichever one it was, they've absolutely cleaned up their business model, and we haven't had that problems in decades. But that problem was significant for us as accountants because at that point in time, we started changing the way we present financial statements to donors and grantors to look like what you see on the screen. And the reason we did that is because if I'm a donor or grantor and I don't have to be an accountant, anybody off the street can look at the total expenses in this example and say, oh, I'm going to round this to $3 million. The total expenses were $3 million. Of those $3 million in total expenses, again, I'm going to round my numbers, 2 million was used for programmatic purposes. So in the example on the screen, 2/3 or 67 cents on every dollar donated is going towards the mission of this fictitious organization that I have on the screen. I have talked to a number of fundraisers in various organizations because all of you probably know that your tax return becomes a matter of public record. It's on GuideStar, it's on Charity Navigator. And one of the things that your donors look at, or your large donors look at, is they'll go on one of those websites, they'll look at your tax return, which with some exception will largely mirror what you see here, and they'll hone in on that 2 million, 3 million number. This presentation allows donors at a glance to see how much of their dollar you're spending on your mission. And I always get asked, what's the right number for that? And my answer is always the truth. The truth is the right number. That said, GuideStar and Charity Navigator and so forth will rank you higher if it's 75 cents on or more on every dollar. However, you should only get to that level if it's truthful. One of the things that we saw on the previous slide, I should have pointed this out, is that at the very bottom of that slide, actually, I'm going to go back. You can see the change in net assets, and it's about the third or fourth row from the bottom. And over in the total column, it's $478,000. This is equivalent to a for-profit where it would say net income. This organization made $478,000 in income.
Jackie,
Mhm.
hi, this is Shelley Huxon. I am confused by when you were talking about the restricted donations that once the money is spent becomes unrestricted. Can you go over that? It doesn't make sense in
Yes.
my head.
That's a wonderful question. So sadly, I have to get into a little bit of accounting speak to answer that question, but the accounting governing body people say expenses by definition are always unrestricted, always. In other words, unrestricted is without donor restrictions. So let's go back to my example of giving Rebecca $500,000 to buy food for homeless people. When I give her the money, she has not spent it on day one. She's done nothing. I just gave it to her. So it will be with donor restrictions. 1 month in, Rebecca spent $100,000 on food for homeless people. Remember, our governing body says expenses by definition are without donor restriction. So when Rebecca spends the $100,000 on food, she can go into the with donor restriction bucket and move $100,000 into without donor restriction so that her revenue bucket is matching her expense bucket. But as long as she doesn't spend it, it will sit in with donor restriction. Once she starts spending it for the purpose I intended her to spend it for, she'll start moving it into without donor restrictions so it matches the expense bucket. Does that help, Shelley?
Yes, that now I understand. Okay, thank you.
Sure.
Hi.
So we talked.
Oh,
Did somebody
sorry,
else have a
Jackie. One follow-up to that. This is
Mhm.
Warner. I think part of what I may not be fully following is
Mhm.
when you start spending it for the donor's intended purpose,
Mhm.
even if you only spend 50% of what they've donated, does the remaining 50% become unrestricted, or do you still have to use that remaining 50% for the intended purpose?
You do. So I love to put numbers and examples. Let's go back to me giving Rebecca $500,000. When she spends 250,000 on food, she can move 250 into the without donor restriction category because she spent it on food. But that means she still has 250,000 in the with donor restriction bucket.
Yeah. Okay. Okay. Thank you.
So there's various different types of donor restrictions, which, well, actually there's two different types, which you see on the slide here. Now, auditors will, on the audit to financial, they'll lump it on the balance sheet into with donor restriction or without donor restriction. But internally, we separate it into temporarily and permanently restricted money. And this is important. And I'm going to give you some examples. So this is a real life example with real life dollars that I remember, believe it or not. And they're huge dollars, which is why I love this example. So years ago, when I was an auditor, I was auditing a symphony that was going bankrupt. And the symphony had a member of its community that had a Bill Gates level of wealth. And this individual in the community loved the symphony and didn't want it to go bankrupt. So he gave them $55 million in permanently restricted money. So what that means is they can't touch it. Here's $55 million, symphony, and you can never touch it. Now, when I tell non-accountants this story, they look at me like I'm losing my mind. How did he save the symphony if they can't touch the money? Because that $55 million is invested in the market and generates earnings. So for simple math in my head, and all of you more market savvy people with me can argue this, but just for the example, let's say the market's yielding 10%. That means that $55 million was generating 5.5 million in revenue every year. And this particular donor said, use the revenue to, my words, keep the lights on, meaning for unrestricted purposes, spend it how you want. So the 55 million was permanently restricted. They can never touch it, but the earnings off of that could be used for whatever they wanted to use it for, because that's what the donor said. More typically, most donors for permanently restricted money will say this, here's $55 million, but I want you to use the earnings on buying a Stradivarius violin. So in that particular case, the 55 million is and will always be permanently restricted, but the earnings are temporarily restricted because the symphony could use the earnings, but they had to use it for a Stradivarius violin. So in my example, which by the way, go for $4 million, that's actually part of a true story. The donor gave them the 55 million and said, use the earnings for whatever you want. And then the donor gave them an additional $4 million and said, here, go use this to buy a Stradivarius violin. So in my example with Rebecca, where I'm giving her $500,000 to buy food for homeless people, that's temporarily restricted. She can use it, but she has to use it for food. Rebecca, any questions that came through the chat or anything?
It's one that I think we should address before we move on, because it has to do with restricted and unrestricted. I know you can answer it really quickly. Does a grant awarded for operating costs count as unrestricted, since it's assumed it can go toward any function in our operating?
Yes. That's a great question. And if you have that, you're really lucky, because as I say, inside the bell curve, grants are usually for restricted purposes, but occasionally there are some that say, go ahead and use it however you want. And those are awesome to have. Honoring donor restrictions, and I touched on this before, is incredibly important because you got to maintain your donor's trust or they're going to stop donating. There are some legal obligations. If I say use this money to buy food for homeless people, and chances are I don't just say it, it's in writing somewhere.
Oh, wow. I cannot believe it.
Oh,
Oh,
sorry, I
no.
thought there was a question. And then when you file your annual tax return, the IRS also requires adherence to donor restrictions. So some of you might be thinking, I'm a nonprofit, I don't pay income taxes. No, you don't. You're right. But you do still have to file the 990 tax return annually. That is largely informational in nature. Okay, we talked about why expenses are divided between program and other. So this is another statement that will only appear in your audited financials, and this again helps donors. So when I talked about breaking expenses, and we saw before, and if you can see my cursor and follow second column from the right, down here that there's that $3 million in total expenses we saw before. And then if you go to the left, 3 columns in from the left, there's that $2 million you see in program costs. So what this does is it gives your donors and grantors a little more detail. On that first statement, we saw that you're spending 67 cents on every dollar for program purposes, but that's all we saw as a donor or grantor. Now we can come to this statement and see, okay, your total wages were 1.6 million, far right. Of that 1.6 million, 630 was for animal care, which is a mission-driven item, 480 education and outreach. So of the 1.6 million in total salaries, you spent 1.1 on programmatic activities. And then over here, you spent, I can't do math in my head, but call it 540,000 on fundraising and management in general. So again, if you look down the left side here, these are more of the categories that you're going to see for internal purposes on your budget to actual salaries and wages, in this case, animal food and supplies, benefits, etc. So this is the balance sheet, or as we say, call it in a nonprofit, the statement of financial position, but I'm going to use the word balance sheet. The important piece to this balance sheet is down at the bottom, net assets. Notice it's also split without and with donor restrictions. So let's go back to me giving Rebecca $500,000 to buy food for homeless people. When LeBron's season stats zero out and aggregate in with his career stats, which is right here in this net asset area, they maintain their character. So when I gave Rebecca $500,000 to buy food for homeless people, if she didn't spend any of it that year, it will stay in with donor restriction and it will aggregate into the career stats down here and with donor restriction. Now to go to one of the questions earlier, but I'm going to change the numbers up a little. If Rebecca spent 300 of the 500,000 I gave her on the food for homeless people, 200 would be left with restriction because I gave her 5, she spent 3. 200 still has restrictions at the end of the year. So only that 200 would aggregate into the with donor restriction number that you see on the screen. So your revenue that you took in the previous years keeps its character when it aggregates in with the balance sheet here. Now I'm going to give you a dirty little secret for quickly figuring out how much money your organization has to keep the lights on. Because one of the common things that nonprofits do is they get my $500,000 to buy food for homeless people, and they put it up here in their normal cash account. And that's fine. You do not have to have a separate account for your restricted money. Totally fine. But often the problem that nonprofits run into is that they're not keeping their eye on the money ball. And all they see is that they have, in this example, 890,000 in cash. Oh, I can spend 890,000. The problem is Some of this is restricted. So if you've run out of unrestricted cash, now you're spending restricted money for purposes it wasn't intended. You don't realize it, and you're potentially getting your organization into trouble. So the best way you can figure that out using the example on the screen is at the tip top, you've got cash for 890,000. Right under that, you've got investments for 858,000. And then down two more, you've got cash restricted to a building project for 250,000. So again, I don't do math well in my head. I'm going to round to 9, that's 1.8. Let's call it $2 million this organization has between cash and investments. It's got $2 million. Again, I'm just rounding the numbers, 2 million. Now this nonprofit leader can drop down to the bottom with the donor restrictions is $600,000. So what this tells me is 2 million in total cash and investments minus 600 that has donor restrictions means this nonprofit leader has $1.4 million to spend on keeping the lights on. So that said, I'll pause for a minute to ask Rebecca if there's any questions.
There's some conversation going back and forth about endowments and how you can negotiate with the donor to help that go towards the organization. There have been some good advice or just talking in the chat around that issue. One question
it.
just regarding the statement of activities that you showed, that was by class, correct?
I think the last, let me go back.
I think it was back further.
This here or
report
further?
state-
That one, that's the one.
that
It was me that asked the question, but yeah, is that statement of activity by class?
Now, when you use the word class, are you thinking about QuickBooks, how QuickBooks has a class?
Yes.
So that's such a good question. When we go in and help clients, that's how we set it up so that it helps us prepare this report for the auditors. So when we do it, we would set up a class for animal care, a class for education and outreach. We would probably call one class over marketing. We might have another class for fundraising that would aggregate for audit purposes into this fundraising and development category. But yes, the easy, direct way to answer your question is a well set up accounting software, yes, has classes for this.
Thank you.
And furthermore, because the audited financials fly at a little bit higher level than you may manage at, in your animal care class, you might have subclasses under that. You might have veterinary care, you might have rescue care, whatever that is, that roll up into animal care.
Perfect. Thank you.
Glenyce.
Thank you. The previous slide where you just had the example of how you could kind of establish where the organization was financially. Can we look at that one more time?
You betcha.
That one. Okay. So my question is here. So we were talking about the 3 different areas where you can look to total the cash, I guess. And one of the areas was cash restricted to building project. So that's considered, I guess unrestricted was restricted, but I'm confused.
So that tip top is just telling us how much cash we have and where it's at. So your organization might get 250,000 for a building project, but not put it in a separate bank account. It doesn't have to put it in a separate bank account. So all I'm doing is saying, okay, given that, this top part, what accounts here are cash or investments? Just like you in your personal life, probably have your retirement account that you try not to touch, and then you have your emergency savings, and then you have your checking account. When you go to get a mortgage loan and your banker wants to know what your assets are, you don't tell your banker, well, this is my retirement account, this is my temporary save. You just give them the total of all the money you have. So that's what's going on here. This particular organization, again, fictitious, broke out its cash between cash and cash equivalents, investments, and then they didn't have to, but they chose to put this $250,000 in a separate account and call it restricted to building project. That name
Okay.
doesn't matter. All that matters is the total of cash and cash equivalents is what I say, $2 million when I just round it for easy math in my head.
Yeah.
$2 million. Then the nonprofit leader is going to say, okay, I have $2 million. How much can I spend on keeping the lights on? Well, that's a nice and quick and dirty calculation. Go down to with donor restrictions. You can't spend with donor restrictions to keep the lights on. You got to spend it for the donor's purpose.
Right.
So $2 million minus $600,000 tells you have 1.4 million to keep the lights on.
Yes. I think I'm getting hypersensitive to restricted and non-restricted.
Good, you should.
Oh, good. Okay.
That's a good management philosophy to have. So good.
Thank you.
Okay, I think Rita has a question. I don't always see the hands pop up.
Yes.
But I think
Yes, thank you. And I think maybe I'm just either confused or doing math in reverse. So when you were talking about how much how much you have to keep the lights on, and it or at least what I'm looking at, it looks like you have about 2.1 million without donor restrictions. So what is reducing? I think the amount you said might have been like 1.4 or 1.6. What number is reducing that if you have 2.1 that have without restrictions? Is that the liabilities that are pending or no?
no, but your question is excellent. And I'm just, you can definitely email me
Okay.
about this for a deeper answer, but I'm just going to give you a surface answer because now we're getting into accounting stuff. The difference is when, let's pretend that your organization gets pledges. So I gave you a pledge for $10 million. You don't have the cash, but the accounting rules say that once I give you the pledge and put it in writing, you record $10 million in revenue. And so that revenue is dropping into, if I give you $10 million to buy food for homeless people, I've just given you 10 million, I've pledged to give you $10 million. It's restricted to buying food to feed homeless people. It's going to close out into this with donor restrictions.
Mhm. Okay.
So Rita, your very observant question was there's roughly, I think you did the exact math, 2.1 million in cash or whatever. Let's call it 2 million for the math in my head. There's roughly 2 million in cash, but you're without donor restrictions down here shows 2.1. Why is cash short $100,000? Because it's probably not cash. It's probably a receivable or a pledge.
Okay. Thank you.
And that's very confusing because we're getting into accounting stuff. So that's why I'd be happy to go more in depth if you want to email me. Okay, we covered this, why net assets with and without restriction are important. So here's the common accounting challenges, and then I think we're right at time. The common accounting challenges are Glenice's issue, which I love her issue because she's not going to have this challenge now, is focusing on that with and without donor restrictions to make sure that you don't spend money restricted for unrestricted purposes. The other challenge is grant management. If any of you have large grants, especially government grants, you've got to be fiscally responsible. You have to be on top of your game, and the grantor will ask you to report what you spent with their money. So, and usually grantors have reporting deadlines, and a common question I get, what are the deadlines? I don't know, every grant's different. You have to read your grant to read what your grantor wants. And then there can be regulatory issues, like if you've permanently restricted money, there's some state laws around how you handle that. And of course, you might need a charitable solicitation license, and there's your 990, et cetera. And then your final challenge, and of course, since we're in the outsourced accounting arena, we are exclusively catered to nonprofits. I will tell you, talent, particularly nonprofit accounting talent, is at a shortage. Having been somebody who taught a CPA review course, only 25% of the CPA exams on nonprofit accounting. So essentially, it's really not learned well by accountants. So talents are an issue right now. And that said, it looks like Casey has a question, which is perfect timing because, oh, no, I have one more slide if we have time. Go ahead, Casey.
Thanks. Yeah, I just wanted to ask if you could do a quick rundown of your understanding on auditing standards as it relates to nonprofits. I understand that audits are kind of generally required once you hit a certain budget threshold. Can you just speak to that, or do you need more clarity in my question?
No, this is a super great question. So like all good accountants, my answer is it depends. So typically, if you're out soliciting contributions, and this varies state by state by state, but you're likely to need a charitable solicitation license. And the important words in what I said is it varies state by state by state, because not only is your requirement to get one different by state, but also those thresholds for audits are different by state. So one state might say, if you have more than $500,000 in fundraising kind of revenue, you need an audit. Another state might set that threshold at $1 million. I'm making these numbers up, but my point is each state differs. So you really have to see the charitable solicitation laws in your state. The other thing that can impact that, the next thing, is if you have loans from a bank or you have grants from grantors, those agreements may require an audit. And again, I can't blanketly say they do, and I can't blanketly say they don't, because it's going to be unique for each grant agreement or each lending agreement. Casey, did that answer your question?
It did, yes. And that the impetus for my question is basically that my organization currently doesn't meet the annual budget threshold for a required audit. However, we do have a grantor this year that is newly requiring an audit. So I was kind of just trying to get a little more information on what that looks like. And we feel pretty well prepared to request, some concessions within that and things like that, given our budget concerns and all those things. So I just wasn't sure if you had any other information that might help us in making that case, but your answer was helpful. Thank you.
I actually do, Casey. There are some step-down versions that independent audit firms can provide, services that independent audit firms can provide. So your grant agreement may require that you get an audit, and obviously you have to until you get your grantor to concede. But a step-down version of an audit is officially called a review, and that's less work and often less expensive. So if you're going to negotiate with your grantor, you might ask them if you can get a review instead of an audit, and that can save you tens of thousands of dollars if they agree.
Thank you. Yeah, that was something I discovered in just a Google search, but it's good to hear it from the mouth of someone who knows what they're talking about. So I appreciate that response.
Thank you. So I'm going to hit on this quickly because we've run out of time. But the best practices for nonprofits, and this is where I see over and over and over again that nonprofits could get huge improvements. Best practices is that oftentimes the nonprofits are using accounting software that's vintage 1995, which it wasn't as good back then as it is today. Or frankly, I've seen one using a software vintage 1979. And so the repercussions for you as the organization is that now you're operating terribly inefficiently because you need a lot more manual processes and controls when you're using a software that's dated 1995. Now, there's very good thinking for that at one point in time. At one point in time, softwares were $30,000, $50,000 a year. It was cost prohibitive, so you had to keep what you had for a long time. That is no longer the truth. So if you're using older software, a best practice would be to update that software and use something more current. The other typical problems we see is that nonprofits will update their software, yet they continue practicing very large inefficiencies in the processes. They've built processes for 1979 software, but yet they're using 2025 software. So once you switch your software, you can often change your processes to be more efficient. Because of all of those reasons, I've seen far too many nonprofits who only issue financial statements once a year when they need to get an audit. And as we discussed earlier, it's really important to look at those monthly, like LeBron James. If LeBron James didn't look at his footage of his game after every game, I promise you he would no longer be in the NBA. Promise you that. So if you want to be a fiscally healthy organization, it's critically important that you look at your numbers monthly and that you have the software and the processes that can support a cost-effective method of giving you those numbers. Another challenge is internal controls. Stronger internal controls typically take more people. However, there are also what we call mitigating controls that smaller organizations can put in place to still have strong internal controls, but maybe 1 or 2 people in the accounting department. And that said, I've gone 2 minutes over. So thank you everybody for being here. And I've got about 5 minutes or so. I can answer questions if anyone wants to stay around and has any questions.
Jackie, if anyone has any real burning questions, we'll let you raise your hand. Just a couple minutes left. I loved all your analogies are helping us to think about this in a different way. I could tell a lot of people it just clicked. So thank you.
Usually when I bring up LeBron James, people are like, what?
Jackie,
Mhm.
I'm with a nonprofit that's just starting out, just starting. We just got our 501c3, and the attorney that filed the paperwork misfiled us as a private foundation, which means we have to do something called a 990 PF instead of a 990 thing. I think it makes a big difference, I'm told, in what we have to file and the complications of how to file it. We've been given directions on a form that we have to fill out to change it, but that's going to cost us some money and apparently some time. Is there any, I don't know if you've run into this, if there's a way to get that reversed, to get it so it is a public foundation so that we can just do the 990 instead of the more complicated thing?
We have to file a 990 either way. The bigger issue with the foundation is that there's more tax consequences as a private foundation rather than a public charity. And usually whether you're a public charity or a private foundation is driven by your revenue and how much comes from a private foundation or a family foundation versus how much comes from the general public or grants, something like that.
Yeah,
As
we're
far
just
as
starting out. We're just starting out, so it's not like there's any pool of money or anything that's sitting there that started. It was a misfile. Now we're told that the 990 PF is much harder and detailed to complete than the 990. Is that not true? Or
I would argue they're both equally bad.
oh,
But that is something to talk with a tax professional about. And our wheelhouse, we're outsourced accounting, where we don't deal with the taxes. So
okay.
sadly, I can't help you with that tax specific question.
Okay. Thank you.
Sure. Anything else? Right, Rebecca. Well, thank you very much.
Yeah, thanks so much, Jackie. I know some of you will be joining us at next week's part 2 session or another webinar that we're having with Jackie. So she'll make a repeat appearance with us. Really appreciate everyone joining. The slide deck and the recording will be sent out usually about within 24 hours after this session. We also invite you to go ahead and complete the evaluation, which we share with Jackie, a summary of results of that helps to inform her for future sessions like this one. So with that said,
But
thank you.
Rebecca,
Yeah.
only 5-star reviews.
That's right.
Nothing
That's
less.
right. Exactly. Thanks, everyone. Really appreciate you being a part of today's session. And thank you again, Jackie.
Thank you. Bye-bye.
Bye.